Hello again and welcome to a new video on this introductory module. Right now we are going to be talking about trading orders, all the different orders that there are in the Forex market, or actually any speculation market. You can apply this video, the concepts and the principles on this video actually to any type of trading markets, such as the stock markets, the futures, the options, etc., etc. So, but obviously we are going to be applying it to Forex. So we are going to be, as I said before, reviewing the different types of orders and how to use each order for one specific purpose. Let's get going. I guess we should start off by defining what a trading order is, and that's nothing but simply an instruction you send to the market in order to perform one specific action for you in your name, such as, for example, to buy an asset, in this case currencies, since we are Forex traders, or to sell that asset, or assuming you are already involved into a trade, one order could be to, well, exit out your position or to add up to your position, meaning if you were long on, for example, the euro against the American dollar, well, you could say you could instruct the market, your broker, to double up your position and to rebuy into the euro against the American dollar if you believe that it's going to continue going up, etc., etc. There are many types of trading orders, and that's what we are going to be reviewing in this video. We are going to start off with obviously the most simple one, which is a market order. Market order is nothing but an instruction to buy or sell the asset at the ongoing market price, at whatever price is currently available in the market. So if you have two buttons on your trading platform, one is to buy and the other one is to sell, and you just click on any of those buttons, the instruction goes through right away. And, well, your broker will fill you in the market at whatever price is available right now. So, if the euro is currently trading at 127.50, that's the price you are going to get, or the closest possible your broker will be able to find available for you. It could slip you for 1 or 2 pips up and down. This could become 51, 52, or 49, 48, whatever. Usually, in a very liquid market such as the Forex, you always find an available price at the precise time you click on the button. Okay, so in liquid markets, such as Forex, as I said, a market order is usually an order to buy or to sell at the ongoing market price right now. Okay? Next up, what's a pending order? A pending order is an order to buy or to sell whatever specific asset you are trading at a different price than the ongoing market price. At the end of the day, you are a trader, it's your money, it's your account. You can instruct your broker to buy or to sell for you at any price you wish. You don't have to agree at the ongoing market price. All right. If the euro is traded at 127.50, you can instruct your broker to buy euro against the American dollar for you only if the euro goes up to 127.80, for example. Okay. Or you can tell your broker to buy euro against the American dollar if the euro goes down to 127.10. All right. Basically, what you are telling your broker is, yes, I want to buy the euro against the American dollar, but I do not want to buy, or I'm not interested in getting involved in this market at the ongoing market price. I only want to buy at this other price of my choice. Okay. Actually, let me pull out my chart so we can drive the point home right away. Here we are with the real Forex chart, the GBP, the sterling pound against the American dollar on the 1 hour time frame. As you can see, ongoing market price is 145.19. If you were to, let's imagine you want to go long in this market, you want to buy the sterling pound in terms of the American dollar, If you were to send a market order, you would be filled. You would be in fact buying, indeed buying this sterling pound against the American dollar at 145.22. That's the ongoing market price. If you click a market order, that's the price you will get. Now, instead of that, you can instruct your broker to fill a pending order or to send a pending order to the market for you. You can instruct your broker to send a buy order above the ongoing market price or below the ongoing market price at any level you wish. Okay, as I said before, it's your broker, it's your account, it's your money, and you decide at which price exactly you want to get involved in this market, you want to trade this market at. You don't have to agree with the market price. The ongoing market price, if you remember at the beginning of this introductory module, we established that Forex is just like any other market where people want to buy and where people want to sell one specific asset. The fact that this asset is being traded right now at 145.25 does not mean that you need to agree with this price. Okay, you can set your offers of, you can send your prices to the market at any level you wish. Obviously, that's one side of the coin. The other side is finding a counterpart willing to match your offer. So, for example, if the ongoing market price is 145.26 and you want to buy the sterling pound against the American dollar at 142.30, okay, you tell your broker, okay, send a buy order at 142.30. That doesn't mean that your broker is going to be able to actually execute your order. Why? Because people who want to sell the sterling pound against the American dollar can easily sell you at this ongoing market price. Okay, so why should they sell the sterling pound against the American dollar at 142 if they can sell it at 145? It doesn't make sense. Okay, so what I'm trying to say is that you can send your buy order at this level, but it's not gonna be filled, it's not gonna be executed until price in this comes down. If eventually it comes down to this level, whenever it touches this price, your buy order will be executed and you will effectively be filled in this market, and therefore you will be long at that precise time on the sterling pound against the American dollar. Until that happens, until price indeed comes back down here, you've only sent an order to, let's say you've only said, hey guys, I'm interested in buying a sterling pound against the American dollar at this price. That's all you've done. You are still not long in this market because your order has not been filled. Your broker hasn't been able to match your buy order with a counterpart sell order. As long as price floats above your price level, you are still not long in the market. Okay, that's important that you understand. So, if a pending order we've just already established, let's get going, let's sum it up. Sometimes I lose track of myself, I rumble away. Anyway, if ongoing market price is 145.30 and you don't want to buy or to sell at that price, you can send a pending order which will be, let's say, floating in the market until price indeed goes either up or down to your designated level, and therefore your order will be filled in the market. If you are looking to go long and your order is below the ongoing market price, this is what's called a limit buy order. This is a limit buy order. All right. If you want to go long and you set your price above current market price, that's what's called a stop buy order. Okay. This is just terminology. There is no other way around but just to learn it by memory. Don't you worry, once you've used this type of orders a couple of times, you will remember the terminology right away. At the beginning, like I say, I do understand that it might be a little bit difficult, but again, once you've used them a couple of times, it's very easy to remember. If you want to go long, try and your order is above market price, that's a stop buy order. If it's below, that's a limit buy order. In the other hand, if you want to go short, meaning that you want to sell the sterling pound in terms of the American dollar, and your order is below the ongoing market price, this is what we call a stop sell order. And if it's above, that's a limit sell order. Again, I know I made a little bit of a mess there. Ongoing market price, you want to sell, you want to go short. If it's below the market price, that's a sell stop order. If it's above, that's a sell limit order. Okay? Again, that's just simply terminology. You'll have to understand. You'll have to learn that by heart. No other way around that. But it's not really difficult. Okay. So to sum it up, yeah, if you tell your broker to buy right now at the ongoing market price, that's a market order. If you tell your broker to try to search for a buy or a sell position to on your name at a different price than what's being traded right now, either above or below, that's a pending order. Okay? Moving along with the presentation, we can find trade management orders, which basically mean orders that take place once you are already into a trade. Let's imagine either your market order or your pending order has already been filled. Okay, your broker has already matched your order with a counterpart in the market, and therefore you are either long or short in the market. It doesn't matter. Well, now it's time to manage the trade, and the two most common type of orders to manage your trade are stop losses and targets. Okay, the stop loss is the order we use when we want to limit our maximum potential losses. For example, let's say you've bought the euro against the American dollar at 127, and you tell your broker, okay, the maximum amount of loss I want to take on this trade are X pips, okay, an X amount of pips. If price turns around against me and goes against my best interest for more than those X pips, please just exit my trade automatically, because I just don't want to overstretch my loss any farther. Okay, that's what a stop loss is. It's an automatic exiting order to fill you out of the market whenever things are just not working as expected. A target is the opposite. A target order or a target price is your desired exiting level when price indeed go in your direction. So again, if you entered long on the euro against the American dollar at 127, and you tell your broker, all right, I'm shooting for about 200 pips on this trade. Whenever I am 200 pips in profit, please simply cancel out my trade, exit out my trade, or reverse my trade, however you want to call it. Just get me out of here with my profits, because I'm happy with this trade, I'm happy with the profits, and I just want to cash them out. Okay? As usual, a picture is worth 1,000 words. Well, in my case, 10,000 words, since my English is rather inefficient. But okay, just gonna explain the stop loss and the target price on an actual chart. Again, we are back to our sterling pound against American dollar 1 hour time frame chart. Imagine you went long right now at this current market price right there, 145.40, and you were shooting for about, let's say 200 pips on this trade, which is around here, 147.40, somewhere around there. You would place your target price, there you are, at that level, 147.40, 200 pips above current market price, and let's say the maximum amount of risk you want to take on this trade, the maximum potential loss you are willing to accept on this trade is 100 pips. Well, therefore you would place your stop loss somewhere around there at 144.40. That would be your stop loss. Okay, it's both of them are automatic. You punch them in, you punch your desired exit levels, both if things go wrong, if things don't quite work out, and also the target price, which is the opposite, if things do actually work the way you expected. Like I said, you punch those values at the very same time you send the buy instruction to the market, so they are automatically set within the trade. You enter both the entry level, which if you picked a market order would be 145.40. You also establish your stop loss, again as we've already established, 144.40, and your target price 147.40. Now you can walk away from your trading computer, from your trading session, knowing that your broker will exit out of the trade automatically, both to the upside and to the downside. Obviously, if instead of going long you went short, okay, and this was again your entry level, you are looking to sell the sterling pound, or you are expecting the sterling pound against the American dollar to go down, obviously your stop loss would be above current market price, and your target will be below current market price, because obviously you are expecting, since you go short, you are expecting the pound to lose value if compared to the American dollar. Therefore, you expect price to go down, and if price indeed goes down, you would be in profits, therefore hitting your target price. If things don't quite work out and price turns around against your best interest, well, once you've reached a certain amount of loss that you've predefined, in this example we were picking 100 pip stop loss. Well, if price goes to 101 pip against you, well, in that case your broker would automatically fill you out of the trade, and well, at least you've limited your losses. Okay, the point of a stop losses are to protect yourself in case you enter the trade, you walk away from your trading computer, and you know that at least the maximum amount of money or the maximum amount of pips you're going to lose in that trade is 100 pips. Stop losses are crucial when it comes to trading. The thing is that trading without a stop loss in place is pretty much suicidal. The Forex markets are known for wild and rapid price shifts, and if you don't have your stop loss in place, you can be caught up in any of those price shifts. At the end of the day, no trader can be stuck to their to his or her trading station 24/7. At some point, you'll have to stop monitoring any particular trade you may be involved with, and you never know when those price changes may happen. So in order to avoid being caught up on a sudden move against your best interest, it's always a good idea to have your stop loss in place at the very same time, from the very beginning. When you place your trade, just go ahead, punch in your stop loss, so you are actually able to walk away from the computer knowing that, well, no matter what happens, your risk, your potential maximum loss on any particular trade is limited by your stop loss. Now, once you are actually in a trade and once you've already punched in your stop loss level, There are two ways of managing your stop loss. Well, first of all, you can move your stop to break even, or second, you can use trailing stops. Moving your stop loss to break even basically means offsetting the risk of a trade once that trade is showing some profits. For example, let's imagine on this chart, on the GBP against the American dollar, right now you punch in a long market order and you are filled long in this market at 144.06. Now let's imagine you place your stop loss somewhere around here and your target price somewhere up there. As price develops, as the chart evolves, you see price moving in your direction, going up and somewhere around here, let's assume you are plus 150 pips in profit, and well, you want to offset the risk on this trade just in case price turns around sharply overnight, whatever, and well, before risking having the trade hitting your stop loss and therefore scoring a loss for this trade, now that you are that you have some profits banked, that this trade is sitting at plus 150 pips in profit, well, how about if we simply move your stop loss up to entry level? So again, if price decides to turn around, it will knock you out of the trade automatically. Remember that stop losses are automatic orders. It will automatically knock you out at plus zero. Basically, you will exit the trade at break even. So virtually what you're doing by moving your stop loss to break even is to offset the risk. Price at that precise time where you move your stop loss, price was somewhere around there. Now basically what you are doing is you are riding a free trade. If price goes up in your direction on its merry way, well, you will hit your final target and you will make some money. In the other hand, if price turns around and hits your trail, the stop loss, your stop loss which is placed at break even right now, then you will be knocked out of the trade, well, without scoring any loss, no profit, no loss, but at any rate, it's a risk-free trade, okay? That's why usually when it comes to trading, being able to move your stop loss up to break-even level is usually a good idea to take out all the risk on that particular trade, and therefore to be riding a risk-free trade. Moving your stop loss to break even is just one way of managing your stop loss policy once you're in a trade. But in fact, there are other ways, such as, for example, using trailing stops. Trailing stop is using a trailing stop basically means pushing your price up or tightening in your stop loss as the trade develops in your favor. For example, you can instruct your broker to keep pushing your stop loss up at a fixed rate, let's say 100 pips from current market price. So as price moves little by little in your direction, and you obviously are profiting more and more and more, your broker will be trailing, will be pushing up your stop loss in such a way so it's always remaining 100 pips behind current market price. Let me show you an example on my chart. Let's imagine you go along right there at 144.31 and you place your stop loss down here. Well, as price begins to move up, okay, you can instruct your broker to keep moving or to keep trailing your stop loss in a way that's always 100 pips from the current market price. Obviously, if price turns around, your broker will not proceed to push price down anymore. Otherwise, that would be self-defeating, right? Your broker will only push your stop loss as long as the price continues moving in your direction. Okay. Once it's here, imagine price turns around. Well, your stop loss will remain there. Imagine from there price continues moving up. Well, as it makes new highs and your profits continue to grow, your broker will continue pushing your stop loss in your direction, even beyond the break-even level. Okay, with the break-even level strategy, we simply moved in one go your stop loss from its original place down here all the way up to break-even in one go. Okay, in one jump. The trailing stop strategy, the trailing stop method, is more, let's say, more progressive, okay, more steady. It doesn't quite jump, your broker doesn't quite move your stop loss in one go from its original position, bang, up to break-even level. It goes pip by pip as your profit grow over time. Okay. Two different strategies, basically the same goal: to offset as the trade evolves, as the trade develops, to offset parts of your risk of your trade, and therefore little by little minimizing the risk on that particular trade. Managing your stop-loss policy correctly once you're in a trade is utterly crucial to Forex traders, and in a future module, I'm going to dedicate an entire section to teach you guys how to manage your stop-loss policies, where to locate your original stop-losses, where to or when to move the stop-loss to break-even, how tightly to trail your stop-loss as the trade develops in your favor, etc., etc., etc. It really is that important. Stop losses is one of the keys, the main keys to long-term Forex success. So don't you worry, we are going to be covering the stop losses in detail in future modules and in future videos.